Every single day, millions of Americans wake up owing money before they earn a single dollar. Their mortgage, their car payment, their student loans, their credit cards. For many, nearly every paycheck is already spoken for before it even arrives. The strange part? People are working harder than ever. Technology is more advanced than ever. The economy is larger than ever. So why does escaping debt feel almost impossible? Because the biggest trap isn't how much people borrow. It's how the entire system quietly rewards staying in debt. And once you see how it works, you'll never look at money the same way again. By the end of this documentary, you'll understand why millions of hardworking people stay trapped in debt for decades, even when they do everything they're told. We'll uncover how banks make money from debt, why interest quietly works against borrowers, and how modern consumer culture keeps people spending long before they can build real wealth. Most importantly, you'll discover why some people seem to escape the cycle while others spend their entire lives running on the same financial treadmill. Answers are hiding in plain sight. Meet David.
He's not irresponsible. He graduated from college, found a stable job, pays his bills on time, works 40 to 50 hours every week. By almost every measure, he's doing everything society told him to do. Yet every month feels the same. His paycheck arrives. Within days, most of it is gone. Rent, car payment, insurance, student loans, credit card bills, groceries, utilities. By the time the next paycheck is due, his bank account is almost empty again. When an unexpected expense appears, a medical bill, a broken transmission, or even a flight to visit family, the credit card comes out once more. The balance grows. The interest grows even faster. Sound familiar? David's story isn't unusual. It's the reality for millions of Americans. According to multiple financial surveys, a large share of U.S. households carry some form of consumer debt, and many struggle to cover even a modest emergency expense without borrowing. But here's the question that almost nobody asks. If debt is supposed to help people build better lives, why does it so often become something they spend years or even decades trying to escape? To answer that question, we have to go back to a time when debt looked completely different. Because the modern debt system wasn't created overnight. It was built, piece by piece, and every new layer made walking away just a little bit harder. The story of debt didn't begin with credit cards, or banks, or even money. Thousands of years ago, borrowing was surprisingly simple. A farmer needed seeds for the next harvest. A merchant needed supplies before a long journey. A family
Borrowed grain to survive a harsh winter. The debt was temporary. Once the harvest came in or the goods were sold, the loan was repaid, and life moved on. Debt was a tool, not a lifestyle. So what changed? The answer arrived with something far more powerful than gold: modern banking. Banks discovered that money didn't have to sit in a vault to make a profit. It could be lent out, again and again. Every loan generated something incredibly valuable: interest. At first, the numbers looked harmless. A few percentage points, a monthly payment that seemed affordable. But the real business wasn't the loan itself. It was time. Because every extra month a borrower stayed in debt meant more interest flowing back to the lender. Suddenly, debt wasn't just helping people buy things. It had become one of the most profitable businesses in the world. And then, something even bigger happened. After the Second World War, the American economy exploded. Factories expanded, suburbs grew, families wanted homes, cars, televisions, and new appliances.
consumer spending became the engine of economic growth. But there was one problem. Most families couldn't afford everything they wanted up front. So the financial industry offered a solution. Buy now, pay later. It sounded revolutionary.
Instead of saving for years, people could enjoy the future immediately. A new house, a new car, a better life, all with affordable monthly payments. It felt like freedom. But hidden beneath that promise was a quiet shift in human behavior. People stopped asking, "Can I afford this?" and started asking, "Can I afford the monthly payment?" That single change transformed the economy. Because once people focused only on monthly payments, the total cost became almost invisible. A $30,000 car no longer felt like $30,000. It felt like $499 a month. A college education wasn't viewed as a six-figure commitment. It became manageable student loan payments. Even luxury purchases could suddenly seem reasonable if they were broken into small installments. The price disappeared. The payment remained. And that's exactly where the system became incredibly powerful. Because human psychology isn't naturally wired to think decades into the future. Our brains value immediate rewards far more than distant consequences. Behavioral economists call this present bias. Given the choice between enjoying something today or waiting years, most people instinctively choose today, even if it costs them much more tomorrow. Businesses understand this. Banks understand this. Advertisers understand this. Which raises an uncomfortable question. If billion-dollar industries know exactly how our minds make financial decisions, how much of our spending is truly our own choice? The answer begins with a machine that almost everyone carries in their wallet. A machine designed to make spending feel effortless. The modern credit card. And that's where the debt trap becomes far more sophisticated than most people realize. A credit card doesn't feel like debt. That's its greatest advantage. When people hand over cash, their brain immediately recognizes loss. The money is gone.